Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We understand, of course, that your money matters. And this show is geared towards speaking about very basic personal finance requirements of every individual. And oftentimes the topics that we discuss on this show come from regular life, from conversations that I have with various people. And one such conversation led me to today's topic, which is a concept called BC or Bishi, as it is called here in Maharashtra. Now, it's not really a formal subject. It is, what it is a group of people get together, usually it's women, and they pool in money. Each person contributes a similar amount, and they draw lots as to who can pull the entire pool towards them. And you might have come across this concept if you've spoken to the people that work with you in your homes, people who help with cooking for you, or maybe even the upkeep of your home. But don't be surprised if your neighbor is also contributing to a BC, because this is something that goes across strata of society. It is something that is called a kitty in certain parts of the country. It's called BC in certain parts of the country. In Maharashtra, as I pointed out, it's called Bishi. Now, what we're going to discuss today is whether or not you can speak to somebody who is currently contributing to such a program. It's not really a program, but something that is a corpus or a pool that is created, and get them into the formal economy, get them into the financial system, and talk to them about why these very concepts are covered in the formal financial system. I'm joined today by Prableen Bajpai, the founder of FinFix Research and Analytics. Prableen, hopefully I've described this in a manner that is understandable to most people. I was curious about it because I didn't know what it meant. I'm sure that you've come across this as well. Your initial thoughts, and there's no real estimate as to how much money is saved through this means, but I would assume that it's a large amount.
Hi, Alex. Absolutely. I think we've just got different names to it, but it's the same system wherein we have this informal system of saving and also credit provision for women because they're able to take out money from there when it is required without actually paying an interest on it. So it's a very interesting network that runs, Alex, across different strata, like you mentioned. BC, it's also called committee in North India. And different names. Kitty is one name, as we go towards the middle class and upper middle class and higher societies. So different names, but the basic phenomena is the same, that it's sort of rotating. It's an association where, you keep rotating money and your money is getting saved. And without really earning a return on it, you're getting whatever you had contributed from it, at a point when you want. So, for example, if you have a 10-month rotation system and you're contributing 10,000 a month, and you need the money, let's say in the 5th month, because most of the people you are joined with in that group are known to you, you can always say that, I require money this month, so, I would want my name to be there. And you can get that overall sum of, let's say if you're 10 of you, so you get that 1 lakh rupee in the 5th month, but you're not paying any interest on it. That's the good part of it. And you keep contributing your share for the remaining months. So it's a medium of saving. It's a medium of getting a credit, and definitely very, very popular with women. And of course, it all runs in a way where it is a parallel economy. It is all in cash, Alex. And I think it has been helpful for women, especially in the lower strata, to have accessibility to funds, to have accessibility to a bigger bulk of money, which is not available to them, at a time when they need it. Okay. So definitely very popular, but it's still part of the informal system, and so much can be done
and so many
bring
interesting,
it into the formal system.
So many interesting talking points from this, right? Because Prableen, you explained it with 10,000 rupees, but I'm sure you came up with a number just so that we could explain it easily. But what I've been told is that the numbers are actually usually much smaller. You're talking about 5,000 rupee kitties or BCs as they're called. And there are, and I was also told, by the way, Prableen, yesterday, that the term BC is what is, it's come about because there are 20 women that used to come together. And therefore it was BC, right? So what I'm trying to get at is, depending on which part of the period you come in on. So if you're lucky and you come in on the first month, effectively it's like an interest-free loan which you're repaying over the course of the 20 months. But if you come in later, it's like an investment that you're getting a sum on, right? So it depends on where you fall. What are the parallels that you can draw? I'm pretty sure on the credit side there are not really any parallels, because unless you're borrowing from your employer or somebody that you know, you're not going to get an interest-free loan. But there are parallels on insurance, which you just spoke about. If there is a woman in need, usually the community comes together and says, no, you can take my turn and you can take the money. Or there are investments that you can make, right?
Absolutely. Absolutely, Alex. I think the gains and the interest, the real gains are actually, it's not on the paper, but you're getting money accessibility, that's one advantage. But at the same time, if you look at the formal system, if we, look at the smaller token money, let's say 2,500 rupees, and if we take your example of, 20 women, so it's like a 50,000 corpus. So you get access to that 50,000 corpus probably in the 10th month or the 15th month, as and when your turn comes. If you get it in the 20th month, then you're not earning anything over there. So you're just getting your money back. But if you're getting it, let's say, if you opted for it in the second or the third month, then yes, it's like a interest-free loan that you're getting if you, used it for your son's marriage or for your child's marriage or for some other purpose. But drawing parallels, in the financial system, again, we do have a lot of instruments now with mutual funds starting at 250 rupees to with recurring deposits, with fixed deposits, Alex, where with a small amount of money, starting from 200 to 500, you can do a small recurring deposit. You can go to the bank, put money in the bank, and you can actually earn an interest on it. A small example here, a recurring deposit of, let's say, 10,000, because that's initially what I picked, at even 6.5% at the end of 1 year can give you an interest income of about 4,200, which is not bad. If you're getting a 7% interest, then that same interest amount goes up to 4,600. So here, women, I think just for the ease, for the convenience, because there is no paperwork involved, there is nothing that they really need to do. And it's just a small group where, you trust each other and you pool in this money, are doing this. But definitely in terms of, looking at it in terms of, the returns that they're getting, they can definitely be better off if they are introduced to the financial structure where products like recurring deposits and mutual funds can be highly beneficial for them, especially because this is really a near-term product, Alex. And, this is okay for any short-term needs which they have. But there is nothing that it offers for the medium term or for their long-term goals. And that is where I think financial instruments and savings are so important.
You hit the nail on the head, Prableen, because ultimately, if you're looking at the latest data, you're talking about maybe 5 crore unique investors in the mutual fund space. And yes, you have more women that are participating and have been participating based on the latest data that Amphi shared. Of course, that was as of March 2024, where you're talking about 1 in every 4 investor in the mutual fund space is a woman. But ultimately, what you're talking about is the need for women to go out and say, okay, we're going to create these assets for ourselves, which a lot of people hesitate to do because they've seen this go on. And in fact, the reason we're talking about this, Prableen, is because a colleague of mine said that her mom contributes to a BC, and she helps her mom contribute to a BC to the extent of 5,000 rupees a month. So it's not just a particular strata of society, it goes across the board. You just have seen people do this all along. The hesitancy, and here's where I want you to weigh in, the hesitancy in certain cases, in fact a lot of cases, is that I don't want my partner or I don't want my family to have access to these funds, as a result of which I'm not putting it in a bank account and I'm not putting it in a mutual fund. How do you get around that?
That's really hard, Alex. And I think demonetization actually showed that women have always required access to money. They've always, they are great savers and they've wanted money for themselves. And I think from, that chawal ka dabba to a Louis Vuitton bag, we saw that everybody had cash in their purses because they need it. And probably they need money, they need access to money, which is not really under a scanner, that they really don't want to share it with their family because they want the freedom to be able to spend it the way they want. And this is the difficult part, Alex, that there aren't too many ways, where probably you can convince your spouse, because in a lot of families, the system says that if you need money, you just take it from me. Why do you need your own money, or why do you need to have a account in your name, or let's say I have access to funds? So these are things which are very difficult to get around. But I think more conversations about money, this is not something that can change overnight. The popularity of all these systems has its roots in the simple system that we've had, which is basically a patriarchal system that we've had in the society, where men have been entrusted with the responsibility of managing money. And only when I think people like you and money and our next generation, when we have these conversations, I think girls and women will be a part of the system where they are equally managing money. And I don't think that we'll require so many of these going forward. But I think, again, the responsibility also lies with us. If we can introduce people who are working in our homes, working in our companies, to be able to help them, guide them with better options for accessibility to a formal system, help them through the processes, create, a slightly easy way for them to access it and manage, and yet keep it under wraps, perhaps in cases where it is required. I think it can still make some difference.
So here's a suggestion. Why don't I ask you this, Praveen, right? Because this was on my mind as well. What if the people that are watching this program take the initiative to maybe help the people that work with them create a bank account, and you now have a micro SIP. You have 250 rupees, or you have a 500 rupee SIP that is anyway available. I know there are a few people in my organization itself that say that if you put a certain amount of money, I will match that. Is that something that you suggest is a good way to go about it? Because that's a sweetener, right? Ultimately, if you're convincing somebody to do something, you put your money where your mouth is and you say that this is what I'm going to do. But if you are doing that, how do you recommend that you start? What is the best avenue? If you're talking about maybe an index fund, or are you talking about a large cap actively managed fund? What would your suggestion be as to how you can start that investment journey?
I think, Alex, if I have to do it, and I have started doing something like that, you tell them that this is the money that I'm giving you per month. Out of this, you save, let's say, an X amount. Let's say you say that you save 500. And then you incentivize that, okay, another, 500 is what I'll add, but you're not touching this money till the time I tell you. Or, you sort of tell them to not touch it, not sort of redeem it. And the good starting point there can be probably a large cap fund for them. It can be an index fund or a hybrid fund, depending on the goal that the person has. So let's say if a lady has a goal that, maybe 5 years from now, she wants her daughter to be married, or for her own retirement, Alex, especially the household help, they really don't have any pension system. So till the time they're young and active, they're able to work, and after that, they don't. So having some exposure to equity can be so great. And I think if, as people who are employing them, if we can have that contributing mechanism till the time they're working for you, that can be great. And I think a simple index fund, Nifty 50 strategy, or a flexi cap fund, which is large cap biased, can be a good starting point for the long term. And a hybrid fund, a balanced advantage, or a multi-asset fund for the medium term, which is 3 to 5 years horizon. So an SIP there. And other than that, I think, Alex, even a recurring deposit can be really great, because, it's risk-free. So initially, to get them started with something which is, going on a monthly basis, getting deducted, I think a recurring deposit also a great point. So fixed income in a recurring deposit, and little equity exposure through hybrid and a flexi cap or / large cap, I think can be great for them.
And simplicity is going to be absolutely key in this case. Now, moving from one end of the spectrum, and ultimately probably in the first conversation that we just had was aimed at women that are coming up in life, if you can call it that, right? Now, I also want to talk about the other end of the spectrum, because just recently you had the categorization of specialized investment funds, as it's called, SIF, by the Securities and Exchange Board of India. And when it was talked about in that concept note or consultation paper, it was called a new asset class. And it was supposed to slot between mutual funds on one end and portfolio management services, AIFs, or alternative investment funds, on the other. And the minimum threshold for investment is set at 10 lakh rupees. We talked about it then, but there's some clarity that has come through now. What did you read from the latest categorization? It's a lot of long short funds that are being introduced or will be introduced. How do they work?
So a long short strategy, Alex, let's first explain what's the long strategy. So that means that you're investing, you're buying in a security with the expectation that its price is going to go up and you will eventually redeem it at a profit. So it's like a bullish market. So you hold on to a certain stock or a certain asset and you redeem when it's at profit. Or the opposite of it is the short selling. Now that means that let's say I'm going to do this, I'm going to indulge into short selling. So I will be, let's say, trading a stock which is for 50 rupees and I borrow 100 shares of it and I sell them for 5,000 rupees. Now the price declines to 25. What I do, I again buy the 100 shares for 2,500 and I return those. So I make a profit of 2,500. So short selling will involve borrowing shares and then selling them at a price on the assumption that the price will decline. Allowing me, that means the seller, to buy shares back at the lower price, which I did at 25 rupees, and then return them because I had borrowed those 100 shares. So short selling is profitable only when there is a fall in the stock price. So for example, today I bought it at 50 and then later it falls to 25. So there is a profit there. So now with the new category which we have, SIFs, basically SEBI has introduced this mechanism where a long short strategy can work in the same fund, which means that part of your portfolio will be held for the long term, the regular investing which is done, but up to 25% of it, derivatives can be used and short selling will be allowed. And that of course brings in different combination altogether, because till now mutual funds were allowing derivatives, but that was only for hedging purposes, arbitrage funds, where you had the square off had to be done and we didn't have any sort of unhedged exposure short selling. So it's going to be a very interesting and a new combination which has come in. Until now this was only available in AIFs. So from mutual fund now which is being offered with a 10 lakh ticket size, I think people will have access to strategies which has only been available to very, very sophisticated investors. And Alex, this is being done because if you remember the consultation paper also which came, SEBI had said that, a lot of youngsters are getting tempted towards high-risk products which are unregulated with unregistered entities. So, they really wanted to bring in something that, okay, as a retail investor, if you want high risk, we'll give you something which is high risk, but at least it's regulated and it is, nicely governed and monitored by SEBI themselves.
Okay. So I want you to also try and explain why this is considered higher risk than mutual funds. And you explained the fact that unhedged positions are not allowed in mutual funds. You can, to a certain extent, use derivatives to hedge your equity portfolios in mutual funds. But why is this considered riskier than a mutual fund investment?
Right. So till now, Alex, whatever we had, like you said, that, it was, okay, fine, I buy something today. Let's say I buy a HDFC Bank and, with the prospect that I'll sell it in the future. Normal long strategy. And okay, fine, there are market corrections, but it's okay. I'm still holding on to my stock and, I'll wait for it to recover and I'll sell it probably 2 years from now or 6 months from now, whenever it recovers. Now, what happens with short selling now, which is allowed up to 25%, that actually works on, it's like borrowed sort of selling that you're doing. So you're not actually buying something and selling. You borrow those shares, so on a margin, and then you're selling them. So let's say I bought it at 50 rupees, like in my example I told you, and then the price fell to 25 and I made money. But what if the price increased? I still have to repay those 100 shares. So I'll have to, sort of square off I'll have to still settle that total trade which was started. So that is where the risk lies. So short selling is done when you're expecting the price to go down and you're working on borrowed shares. But if the price goes up, then you still have to square it off. So you'll have to, again, undergo a loss and, sort of buy at higher price, settle your trade. And that is where the risk lies. But at the same time, it also can reduce the overall risk of the portfolio because it's considered that as compared to long only counterparts, long short strategies are actually designed to have lower sensitivity to the equity market movements, and whether it is in terms of beta volatility or the drawdowns, long short have over the longer period of time proven themselves as a very good strategy. But yes, it definitely brings in the risk of the short selling. And that is something that we don't have naked short selling. We don't sell anything which is not even borrowed. That's called naked short selling, Alex. Here it is borrowed and then sold. With the expectation that the price will drop in future. So that is the element which brings in the risk into these SIFs.
Okay. Now, I was speaking very soon after this categorization came to light to a mutual fund CEO, Radhika Gupta, and she said that in her estimation, people shouldn't allocate more than 5 to 10% of their liquid corpus or basically their investment corpus to something like this, which I think is a far cry from what people originally might have thought, because you're talking about people with upwards of 1.5, 2 crores of corpus that can consider maybe putting 10% into something like this at the bare minimum, right? So is that something that you agree with? And what in your estimation should be the approach of people that should be investing in this?
I think, Alex, the percentage allocation would ideally depend on, every investor, it would be different. But definitely for investors, let's say who are already exploring with the PMS or exploring with the AIF, this also lowers the concentration risk. In a PMS, you're giving 50 lakhs to one entity. In an AIF, you're giving 1 CR to a certain entity. And AIF's category 3 actually offer long short strategies. So there, all your money, if you're buying, let's say for 1 CR, is with one person. So if your overall portfolio, let's say, is 2.5 CR, and you thought that let me buy an AIF with 1 CR, there is a huge amount of concentration risk there. So with SIFs, I feel that concentration can actually be reduced. So in a way, it can also lower the risk for those who are indulging in AIFs. And that AIF is a very biggish part of their overall portfolio. Because they can have SIFs across, let's say, 2-3 AMCs. They can utilize different strategies, different managers to manage their long short strategies. And that may actually be beneficial for them. But yes, overall, Alex, like we always say, in markets, for example, 6 months back, the risk appetite of everyone was different. Today, it's different. So I guess everybody will have to wait, see if it actually suits their real risk appetite, if they are okay to withstand losses, if they are okay to see how these products work, how they perform. And if they are comfortable with that, then definitely I think maybe for somebody it can even be 20 to 25%, but it'll depend. But that would be a person who's actually already looking to indulge into PMS or AIFs. Well, because those sophisticated investors. For somebody who has, let's say, a 50 lakh mutual fund portfolio, maybe a 10 lakh is quite a lot already. So 10 lakhs out of the 50 is, as it is, 20% of your portfolio. So I think it will depend on the investor and how savvy are they and how much do they understand of this strategy.
Last thought, and we're speaking, Prableen, at a time when you've seen massive drawdowns in mid cap and small cap in particular. And I'm only speaking because you had data over the weekend that came in from Amphi, data as of March 2024 that talked about the fact that in your small cap space, over 50% of that assets under management was through SIP book, right? So when you're looking at redemption in small caps, ultimately or redemption in SIPs, ultimately a large part of that is in small caps, and you're seeing that in the market. Any advice that you would have to people right now if they have overexposed themselves to small cap, either lump sum or through SIPs? Should you shift a portion of that now? Already drawdowns have happened. What's your advice?
I think the pain in the small caps, Alex, would continue for some time. So if you still have a 6-7 year horizon, it's okay to continue. Perhaps the monthly allocations can reduce by a bit. Let's say you're putting 20,000 out of the 50,000 into small caps. Maybe you can reduce it to, let's say, 15,000 out of the 50,000. So depending on what your horizon is. If you have that 6 to 7 year horizon, it's okay to continue. But if you don't, if you have a near-term goal, then definitely time to It's okay to sell even in losses and move out. If your horizon, like if your goal is 6 months or a year away, then you shouldn't think. But if you do have the horizon, then you can continue during downturns.
Fantastic. I think that covers quite a bit of ground today. I think, Prableen, we've spoken about a wide gamut of topics, and we ended with your advice to investors in the mutual fund space in the small cap category as well. Thank you so much for joining me today on Your Money Matters. Absolute pleasure speaking with you.
Thanks, Alex.
All right, that brings us to the end of this program, but there's lots more coming up over the course of the day, and I'd encourage you to stay tuned.